What is up, everybody? Steve here. Thank you for your time today. I want to bring you what I think is a very important article. It's direct from the Fed and essentially goes on to say real-time market monitoring finds signs of brewing U.S. housing bubble. Again, this is directly from the Fed, and I think it's important that we really dissect what they're saying, because the Fed is an important component of not just the housing market but our entire economy. So it goes on to say, we argue that the underlying causes of the run-up differ from those from the last housing boom, which preceded the 07 to 09 global financial crisis. However, there's growing concern that U.S. house prices are again becoming unhinged from fundamentals. And I know for a fact the Fed is going to do everything in their power to not have a housing crisis or a housing crash. And the problem is they only have so many more tools in their toolbox, based on what Powell keeps saying as well, in terms of what they have to do to combat inflation. But the thing is what they're going to do is just continue to raise rates, which is going to have ultimately effect on mortgage interest rates and slowing down the housing market. So let's continue. The rapid real house price appreciation, such that is observed now, does not in itself signal a bubble. Shifts in disposable income, the cost of credit and access to it, supply disruptions, and rising labor and raw construction material costs are among the economic reasons for sustained real house price gains. Now, I made a little note here, cost of credit and access to it. When the pandemic first hit, it was important that the Fed did something. This way we didn't basically just crash and burn into a recession right away, because I think that would have caused possibly even a depression. So they had to do something, but I think that they went overboard by the amount of money printing that they've done, the amount of purchasing of mortgage-backed securities and other assets. And right here is, I think, the main factor that we got to look at, the cost of credit and access to it. Now, if there was not such cheap money out there, then we wouldn't have even some institutional investors buying up people who really needed houses. And ultimately, the cost of credit is starting to increase. So I think that's why they're a little nervous, because essentially spending is going to decrease, personal spending is going to decrease, people's credit card bills are going to go up, along with everything else like inflation and gases, which is going to have an effect on real estate, in my opinion, as well. It goes on to say, but real house prices can diverge from market fundamentals when there is widespread belief that today's robust price increases will continue. If many buyers share this belief, purchasing arising from fear of missing out can drive up prices and heighten expectations of strong price gains. And I made a note right here, FOMO is loosening, and I did another video on FOMO, fear of missing out. And I think that a lot of people are starting to realize that, they're taking a step back and starting to, really think with their brains instead of their emotions. And a lot of times market cycles are all emotionally driven. And I think that that's what we're seeing here, is a lot of people are starting to realize that, forget about being emotional about buying real estate. We're going to step back, see what happens with prices, see what happens with mortgage interest rates. And ultimately, I think a lot of people are kind of removing emotions from their home purchases. This self-fulfilling mechanism leads to price growth that may become exponential or explosive, resulting in housing market becoming progressively misaligned from the fundamentals until investors become cautious, policymakers intervene, the flow of money into housing dries up, and a housing correction or even a bust occurs. And I put a note here, Fed increasing rates and tapering, buying mortgage-backed securities, and mortgage interest rates rising. So yes, the Fed did increase 25 basis points. They're talking another 50 basis points. They're going to have to go a hell of a lot higher to combat inflation. And they're talking about tapering off mortgage-backed securities, where they're buying billions and billions every single month. And now there's talk of they're basically not going to buy any, they're slowing down on buying more mortgage-backed securities, but also the ones that they have, they may consider selling them off, or they may just sit tight until they mature, and then they can take that money and reinvest it, or they can put it back onto their balance sheet. So time will tell what play that they're gonna do there. And then obviously when they're increasing the Fed rates, mortgage interest rates will follow. We're already seeing that, and I anticipate that we will continue to see mortgage interest rates rise for the foreseeable future. Our evidence points to abnormal U.S. housing market behavior for the first time since the boom of the early 2000s. Reasons for concern are clear in certain economic indicators. The price to rent ratio in particular, and the price to income ratio, which shows signs that 2021 house prices appear increasingly out of step with fundamentals. Now, I did another video on price to income and just saying property housing are so expensive. I believe it's close to 7.6 times the annual income for the average family. And back in the last real estate recession, it capped out at about 7 times. So yes, it's definitely a lot higher. And then the price to rent ratio obviously is just destroying people if you're renting right now. Based on the present evidence, there's no expectation that fallout from housing correction would be comparable to the 07 to 09 global financial crisis in terms of magnitude or macroeconomic gravity. Among other things, household balance sheets appear to be in better shape, and excessive borrowing does not appear to be fueling the housing market boom. I think I completely disagree with that. I think they're doing some damage control here, because a lot of people actually have been using their homes as an ATM machine. I think it's something along the lines of 73% of all mortgage originations, whether it's a new purchase or a refi, took place in literally the last 2 years. And that's significant. So you have a lot of people that, have owned homes, and with rates so low, they not only refinanced their mortgages, they did cash out refis to tap in that equity, pulled that equity out and paid off other debts, or got themselves into more debt because of dumb purchases. Again, I know your time is valuable, and I really appreciate it. And if you made it this far and you are not a subscriber, I appreciate you subscribing, because I have a lot more information on housing market updates, and I appreciate everybody watching today. Thanks a lot for being here.